Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. Learn about fix and flip loans, BRRRR financing, rental, fix to rent, commercial, multifamily bridge loans, business loans, and so much more. And now, your host, Beau Eckstein.
Hello and welcome to another episode of the Investor Financing Podcast, and I'm your host, Beau Eckstein. Today, we are talking about value-add multifamily deals and how to finance them. So, you found a property, maybe the occupancy is a little bit low, it's been mismanaged, it needs repairs. It's a good opportunity for you to get this property. Maybe it's your first multifamily, it's a 10-unit or 20-unit building. And now you got to find the right financing, because essentially what you want to do is you want to go in with the least amount of capital, get the property running better, increased NOI, right? Increased income, decrease the expenses, fill the vacancies. Now you've forced appreciation on this property, and you're going to want to refinance and pull out the money, right? Pull out the investor capital, maybe pay back your investors, get them out of the deal, or maybe just return the capital to your investors, keep them in the deal, but have their equity back for new deals, right? That's kind of the way to grow your business quickly, to scale. So what you want to do is you want to first assess the property and really figure out, based on your spreadsheet, your pro forma, what the turnover is going to look like, what the lease up to get the property fully occupied, what's the construction budget look like, how long is it going to take, what's the turnover time. Once you kind of establish that, now what you want to do is look for the financing next, right? You want to figure out what's the best financing, because if you're able to execute your strategy and by year 3 you want to refinance, you don't want to go into a 5-year yield maintenance prepay penalty, which is going to be extremely costly, right? So think about that before you go in. I see so many investors paying off huge prepayment penalties. Luckily, they've made money, a lot of money, but if you can avoid having these huge prepayment penalties. So that's why we always talk about maybe agency isn't the best, maybe a credit union's better, maybe a local bank's better. So that's what we're assessing.
You're listening to the Investor Financing Podcast. We'll be right back after this break. Are you looking for funding? Are you getting frustrated trying to find a lender? Visit investorfinancingpodcast.com and click the Get Funding button. Complete the simple form and schedule a free phone consultation with one of our placement specialists. We have a proprietary directory of funding partners that can help you get the funding you need. It's fast and easy to explore the options available for your specific needs. Don't wait. Visit investorfinancingpodcast.com and get connected.
There's also balance sheet lenders that specifically lend for these type of value-added properties. I have one balance sheet lender I work with that can go as high as 85% of cost for experienced operators, sponsors. So they'll lend 85% of the purchase price and 85% of the CapEx. That's for an experienced sponsor. There's super high leverage money out there for multifamily. It's probably the easiest asset to finance out of all of them. I mean, sure, right now with COVID, there's some caveats with agency debt. You need COVID reserves, you need PITI reserves. But all in all, there's a ton of money for value-add multifamily. Now, if you're buying a property under 90% occupancy, you can pretty much push away agency. You're looking for some kind of bridge financing. Now, there's some banks and credit unions that will fund these type of occupancy levels. If you're talking about something that's 20% occupied, right, that's a completely different story. That's a heavy value add deal, and that's going to take a different type of bridge lender. They're out there. There's loans for pretty much every situation. It's just about putting the package together, putting the capital stack together, because you can get senior debt, you can get pref equity. Of course, we've been talking about my favorite, which is PACE, right? You can layer these financing instruments together and get higher leverage. So whatever the scenario is, there's usually a solution. But value add multifamily property, is where a lot of investors like to be, because they can create the most equity, right? They can force appreciation. They can create the most amount of equity in the shortest amount of time. It's the most work, but you can create the most equity out of that. And obviously when you're starting in real estate investing, that's the whole name of the game. Create huge equity, refinance that, pull your cash out, pay off your investors. You're basically in the deal with nobody's money anymore. And the property's got an equity cushion, and you refinance 75 to 80% of the new value, and then you move on to the next one, right? That's kind of the model. So there's a lot of financing for these type of multifamily value add deals. It's just a matter of your experience level, your sponsorship experience level, the property itself. What does it look like? Is it a huge heavy lift? Is it 85% occupied, or is it 60% occupied? Is it a completely vacant apartment complex that you're going to go in and completely turn over? There's financing for all this, but it's just different buckets that we go into. So when you have a question on your next multifamily deal, feel free to reach out. Thank you for listening, and I'll see you on the next episode.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.